For 2026, picture two massive economic waves hurtling toward each other. One is the AI revolution, promising a surge of wealth and productivity we haven't seen in decades. The other, stubborn, sticky inflation that's threatening to pull the whole system down. So who wins this epic tug of war? In this video, we're going to break down what this clash means for the future of big tech, and more importantly, for your money. All right, so here's the big idea for 2026. We're walking into a new era of a great economic sorting. The old simple story of tech good, inflation bad is officially dead. Instead, we're seeing the incredible deflationary power of AI productivity go head to head with the inflationary pressures of a global economy that's rewiring itself, not to mention the cost of building the AI infrastructure in the first place. This collision isn't going to have one clean winner. It's going to create a market of haves and have-nots. Some tech companies, the ones providing the literal building blocks for the AI boom or using it to become radically more efficient, are set up for some truly historic growth. But others, even some of the giants we know today, could get crushed by high cost, fierce competition, and a customer who's feeling the pinch. The key to making sense of 2026 isn't just to bet on AI. It's to figure out exactly where in the tech world the tailwinds from productivity are strong enough to blow past the headwinds from inflation. The first wave in this collision, the AI boom, is way more than just hype. It's a real, tangible economic event that's already making its mark. We are living through an investment cycle that brings to mind the great railroad expansions or the dot-com build-out of the late 90s. Big tech is leading the charge with absolutely staggering spending. In 2025, the biggest names in tech earmarked a combined total well over $200 billion for capital expenditures. And a huge slice of that pie is going straight into the AI arms race. Companies like Meta, Google, Amazon, and Microsoft have all signaled they're spending even more in 2026. Microsoft, for instance, has talked about doubling its data center capacity, admitting they can't even keep up with the fire hose of demand for computing power. And this isn't just money being tossed at a cool idea. It's a direct response to insane demand, and it's already juicing the economy. The AI boom is a key reason the US economy has stayed so surprisingly strong, with this wave of investment being an important driver of GDP growth. Some forecasts see US GDP growth landing somewhere between 1.8% and 2.3% in 2026. And while AI isn't the only reason, it's definitely a powerful tailwind helping keep the economy afloat. The scale of this spending is so massive that the capital expenditure budgets of big tech now basically dictate the fortunes of countless other companies, from chip designers to software platforms. But where does the productivity part of the boom come in? It's showing up in two phases. The first is inside the tech sector itself. Google, for example, has pointed to billions in quarterly revenue coming from its AI-boosted services, especially in its cloud division, proving these massive bets are already starting to pay off for the leaders. The second, much bigger wave is AI spreading across the rest of the economy. We're finally moving out of the let's play with it phase and into real-world applications. Some early studies have shown that for certain tasks, AI tools can cut the time it takes to complete them by anywhere from 14% to 35%. That means better profit margins, wild efficiency gains, and a path to new products and services that were science fiction just a few years ago. Economists are still debating the long-term impact, but a range of estimates suggest AI could eventually add a few tenths of a percentage point to annual GDP growth in advanced economies. One analysis from the Penn-Wharton budget model, for example, sketched out a scenario where AI could boost productivity and GDP by 1.5% by 2035. This is the powerful, wealth-creating promise of AI, the ability to do more with less. This investment is creating a massive tailwind. It's fueling profits, propping up the economy, and paving the way for a real productivity revolution. But this revolution isn't happening in a bubble. It's running straight into an equally powerful and opposite force. The second wave, the one crashing against AI, is inflation. After years of the Fed hiking rates, we all hoped inflation would be in the rearview mirror by now. And yet, heading into 2026, it's still hanging around, especially in the US. While the dream is 2%, many forecasts see US inflation remaining stubbornly above that target, potentially settling in the mid-twos range. So why is it so sticky? It's not just one thing, but a whole mix of factors. For one, the job market is still tight. It's cooled off from the post-pandemic frenzy, but unemployment is low, and wages are still growing enough to keep pushing up the price of services. It turns out that last mile of the inflation fight is the hardest. Second, geopolitics and industrial policy are redrawing the world map. Governments, particularly in the US, are throwing money at strategic industries like clean energy and semiconductors. While the goal is to build more resilient supply chains, tearing up the old playbook is messy and, in the short term, inflationary.
But here's the ironic twist. The AI boom itself is helping to fuel inflation. The very thing that promises to lower costs in the long run is creating a massive headache right now. Building all these power-hungry data centers is causing an unprecedented spike in demand for energy and raw materials. Research from Goldman Sachs, for instance, projects that power demand from data centers will grow by around 160% by 2030 compared to 2023 levels. This is already straining electrical grids and creating a huge investment boom in utilities and energy infrastructure. This sudden, massive appetite for physical stuff, from copper and concrete to electricity, is pushing up costs for everyone.
So how does this hurt big tech? It hits them right in their valuation. High growth tech stocks get most of their value from profits that are expected way, way out in the future. To figure out what those future profits are worth today, you have to discount them by an interest rate. When inflation is high, central banks have to keep interest rates higher. Even with some rate cuts on the horizon, rates are not going back to zero, with many scenarios seeing the Fed's policy rate settling in the mid to high twos by the end of 2026. The math for tech valuations gets a lot tougher. Those higher rates make distant profits less valuable today, putting a lid on stock prices. On top of that, persistent inflation chips away at consumer spending power, which can hurt everything from new gadgets to streaming subscriptions. And for companies selling to other businesses, higher rates mean their customers are also facing higher borrowing costs, which can lead to slashed IT budgets. This is the powerful counterforce. While AI is promising to grow the profit pie, inflation and higher rates are simultaneously trying to shrink it. That's the economic tug of war that will define 2026. This brings us to the heart of it all, the collision. In 2026, the deflationary force of AI isn't just going to cancel out the inflationary pressures. Instead, they're going to tear the market in two, creating a two-speed economy that separates the tech sector into clear winners and losers. The most important question for any tech investment is no longer, does it use AI, but how does it hold up in the collision? First, let's talk about the winners. The most obvious group is the companies building the foundations of the AI world, the modern-day picks and shovels sellers. This starts with the chip designers making the GPUs and custom silicon that are the brains of AI. Their pricing power is off the charts because demand is practically unlimited. Right behind them are the cloud giants, Amazon's AWS, Microsoft's Azure, and Google Cloud. They're spending a fortune building the data centers, but they're capturing all the value from the millions of businesses that want AI without having to build it themselves. But the winner circle is bigger than you might think. A huge and maybe underappreciated winner will be the energy and utility sector. All those data centers need a shocking amount of power, creating a long-term growth story for electricity providers and the companies that build our power grids. And within tech itself, the winners will be the companies that actually use AI to cut their own costs, boost their pricing, and build a real moat around their business. These are the ones using AI not just as a buzzword, but as a tool to make their own financials stronger and more resilient to inflation. Now for the losers. The most vulnerable are the speculative, high-growth tech companies that still aren't profitable. Back when interest rates were zero, a good story was enough to get funding. In a world where money has a real cost, the clock is ticking on burning cash. The market's patience for promises is running out. Another group of losers will be tech companies that are super sensitive to consumer spending. As inflation chews into family budgets, things like fancy gadgets, extra streaming services, and online shopping sprees are the first things to get cut. These companies can't easily pass on their own rising costs and are directly exposed to a consumer who is feeling the squeeze. Finally, you have what we can call the AI disrupted. These are the established tech companies that are just too slow to adapt. Their old products are at risk of being replaced by cheaper, smarter, AI-native competitors. They'll have to spend a ton of money just to tread water while their main business erodes. Some analysts are already warning about a potential valuation reset for some of the mega cap tech stocks. The fear is that the market has priced in the AI dream without seeing a clear path to making money from it, especially with challenges like power shortages. This is where hype runs into the hard reality of a balance sheet, a risk that many retail investors are now starting to flag. Not every company with AI in its slide deck is going to win. For many, it will just be a massive new cost they have to pay to stay in the game. This collision is a filter. It separates the essentials from the nice-to-haves. It rewards real profits and punishes speculation. For investors, the message is loud and clear. The days of just buying a tech ETF and watching it go up are over. Being selective isn't just a good idea anymore. It's essential. So, what does this all mean for you and how should you think about positioning for the tricky year ahead? The main idea is to look past the hype and focus on the economic reality. The 2026 market is going to reward discipline and punish anyone just chasing the next shiny object. First, you have to separate the different layers of the AI stack. The most durable investments are likely to stay in that foundational infrastructure layer. This means the semiconductor firms designing the chips, the cloud providers building the data centers, and the energy companies that will power them all. These businesses are selling real, tangible things that are in short supply, which gives them pricing power. Their success isn't tied to one hit AI app, but to the build out of the entire ecosystem. Second, for any company outside that core group, the focus has to be on profits and cash flow. Ask the tough questions. Is this company actually using AI to build a lasting advantage? Is it making their business better, or is AI just a new line item in their marketing budget? In a world of higher interest rates, companies with strong balance sheets and a clear ability to generate cash will be the winners, not the ones that need to constantly raise more money to survive. As one Bank of America analyst noted, a valuation reset could be a big story for 2026, where even great companies might not see their stocks rise if they're already priced for perfection. Third, think bigger than just the tech sector. The AI revolution will create huge demand in other parts of the economy. We've talked about energy and utilities, but you can also look at industrial and materials companies that are needed to build data centers and upgrade the power grid. These sectors are often valued more reasonably than tech and offer a different way to play the same powerful trend. Fourth, stay very skeptical of anything that feels like pure hype. We're already seeing signs of AI fatigue, with studies showing that most companies are still just experimenting with AI and haven't gotten real value from it yet. The good news is that even with the excitement, valuations for the top AI players are still nowhere near historical bubbles like the dot-com era, which suggests the market is still thinking rationally. The trick is to avoid getting swept up in the latest craze and stick with companies that have proven they can make money. Looking ahead, here are a few things to watch. Keep an eye on the CapEx numbers from the tech giants. As long as they keep climbing, the foundational AI trade is still on. Watch inflation data and what the Fed says. If inflation stays stickier than expected, it could spell trouble for tech valuations. And finally, read the earnings reports from enterprise software companies. They're a great real-time signal of whether those AI productivity gains are actually translating into bigger IT budgets. The outlook for 2026 isn't scary, it's just complex. It's a market that demands nuance, discipline, and a sharp focus on real value. So in 2026, we're not just watching an economic cycle, we're witnessing an economic sorting. The unstoppable force of the AI boom is meeting the immovable object of persistent inflation, and the result is going to define the tech landscape for years. This new world requires a smarter approach, one that looks past the headlines to the fundamental clash of these two forces. It's a market where the companies providing the essential building blocks of our future will be separated from those just selling a dream. If you found this breakdown helpful, make sure to subscribe and hit that notification bell so you don't miss our next deep dive. We break down the big, complex trends to give you the clear insights you need. And now, I want to turn it over to you. Which tech giant do you think is most at risk in this new two-speed economy? Drop your thoughts in the comments below.